You're listening to The Real Well Show with Kathy Fetke, the real estate investor's resource.
With the 2008 housing crash still fresh on our minds, some people think that same thing is going to happen today. But so far, the housing news isn't all that bad, and this time around, things are very different. I'm Kathy Fetke, and welcome to The Real Well Show. On today's show, we'll take a look at the data and see what it tells us. And today's guests know a thing or two about data. Amy Gromowski is a senior leader with CoreLogic's Science and Analytics Center of Excellence. Jeremy Thomason is the executive sales leader for CoreLogic Rental Property Solutions. And they're here with us today on The Real Well Show. Welcome, Amy and Jeremy.
Thank you.
Thank you.
So really honored to have you here. I'm not even sure who to direct this first question to, but let's just, whoever wants to grab it. Do you see, or do you agree with Zillow's latest projection that home prices would decline by 2 to 3% this year? I think they said property. So gosh, that's a big, big range of things. And how could they possibly know? But I'm guessing it's homes.
Yeah, well, I can tell you our home price growth is projected. Well, it was projected as of March 2020 to be somewhere around 4.5%. But now for March 2021, we're looking at an HPI forecast about 0.5%. So that's more for our metric. I'm not sure where Zillow's starting and dropping from. It's more than a 2% drop, but still home price growth for next year, 1 year out, which is good. It's not going to be a negative.
So
decrease.
you're actually,
of course, that'll vary by market.
Prices will increase overall, but just a little.
Right, just not as much as originally projected.
Okay, that's extremely positive, and I'm in the same camp. Do you think that there will be certain areas where we see higher price growth due to lack of supply or any other reasons?
Well, there's definitely a lack of supply. I mean, we saw that, even just coming into, safer at home orders, the market supply as far as single family homes was low. And then new listings, temporarily at least, it appears, have dropped, and withdrawals increased as far as on the real estate market. But that appears to be bouncing back a bit. We don't know if that's just a temporary, in both cases, or what the future holds. But I think that it remains to be seen. The inventory could, spring back completely and make up for that loss in time, or just kind of stay where it's at, which overall would keep lower inventory. So, and then you've got delinquency rates that are expected to, increase significantly with unemployment. So that could put more inventory on the market as well. But definitely, I think, all signs point that we are not in a position that we were as far as 2007, 2008. Lots of things are different from that market. So, that should keep home prices at least in the positive. And, each market, based on unemployment, each market will vary.
Sure, yeah. And again, property is such a broad term. Do you think it'll be across the board, or any difference between lower end, medium price homes and higher end?
I believe we're seeing that on lower priced homes. The theory is, millennials and people who maybe were adverse to buying properties will now be, this will be their market. Like it'll be prime for them. So I would say, areas that have younger population, unemployment, is going to vary a lot by, markets with high tourism and traveler, right, that depend on that, and the entertainment industry. So you may see more inventory come on the market there. So keep house price indexes lower. Yeah, I don't know. JT, do you have Jeremy, any thoughts?
Yeah, I would just simply say that, the areas that have challenges around whatever their main employment base is. So those are obvious answers. I think one of the things that is forgotten with the COVID crisis is that almost simultaneously, because of the oil prices, OPEC, just the disagreements between Russia and OPEC caused almost simultaneous to the COVID issues that we were having in March, a real decrease in energy. And so over dependence on any one particular industry, I think is always a risk for any housing stock, no matter what type it is. And so with energy being so depressed, I think that puts extra pressure on, places like Houston, as an example. Certainly when you go, Houston is a fairly big metropolis, but when you go into West Texas, that's really difficult in that market. And there's other parts from the natural gas plays, the Balkans and the different areas that have been boom bust markets. Well, we're in the bust side of that right now, and that has nothing to do with COVID, really. It has everything to do with energy. Now, to the extent that the demand is dried up because nobody's driving right now, nobody's flying right now, I think it exacerbates, COVID does exacerbate the issue with pricing the supply of oil, the supply of natural gas just being way past where the demand is. So COVID does impact the energy market, but we were already having a bit of a challenge there beyond the obvious things like tourism and anything related to hospitality. Over concentrations, if the employment base was not diversified, then we end up having some challenges in those particular markets. I don't even know that it matters what type of asset we're talking about, $100,000 home or $1 million home. I think we would see underperformance in those markets just based on overconcentration of certain industries.
It's been so shocking for us because I hear this data and I would agree with everything you say. And then we contact property managers and realtors within our network, and so many of them are busier than ever. They have had normal rent collections within the property management. They've have more applications for rentals than they had before. I've been very shocked to kind of see what's happening real time versus what we might think would happen. But of course we're still early on, right? Anything can happen or change as we move forward. But boy, we've never been quite in a time like this, and it could bounce back overnight,
Kathy,
or it could
there's
not.
a very interesting thing that has emerged. We've been starting to watch it to see if there's real data on this. So at CoreLogic, we participate in a number of the different trade associations, whether it's on the multifamily side, or the single family rental side. I guess 2 weeks ago, I was attending one of the national calls from the NRHC, and they had all of the big institutional owners of single family rentals on. So these are the guys that own thousands and thousands of single family rental homes. And they were validating what you just said, Kathy, about their early traffic really hasn't changed. They're really part of the lease cycle where people are searching for homes. They were as busy as ever. And there definitely was a dip in multifamily. Right. So we do a lot of multifamily work. And so there was a decoupling of multifamily and single family rental demand for a period of time. And we don't exactly know why, but there is people that are putting theories out. I happen to believe this theory that social distancing and density can't coexist.
Right, at all, yeah.
So that puts a stress on multifamily compared to single family rentals. And so people are flighting to the suburbs from the urban core for a rental. Then potentially that is one of the reasons why the single family side of the rental space, whether it's mom and pop or institutionals, are seeing hyper demand for the rental stock that they have. And that market's a bit fragmented because it's dominated by mom and pop. And so it's really hard to get your head around the data in that space. But with the institutional guys, they're definitely seeing it and feeling it, and you can see it in their metrics.
Absolutely. I mean, I talk to guys in Detroit, and I'm just waiting to hear, how terrible things are. And they tell me they're busier than ever. And it may be for that reason, because they do have a very specific buy box of good B-class neighborhoods, single family homes, affordable. and they're going like crazy. They don't have enough inventory. That shocked me. But then what shocked me even more, because I thought that the higher end, and especially the bubble markets like San Francisco, where I'm from, would get hit. And my niece, who's a real estate agent, she said she's never been so busy. And I thought, oh, sure, the affordable home, which would be under $1 million in San Francisco. She said, no, all price points. So it's very interesting what's going on out there, and a lot of it doesn't make sense. But let's just say that we do. I mean, do you think, and I'm sure it just depends on how long this drags out until we find a cure or a vaccine or something. But do you anticipate that we would see an increase in foreclosures and bankruptcies over the next 6 months?
Amy, if you want to take that one first.
Yeah, sure.
I have an opinion on it, so go ahead.
Yeah, so the projections right now around delinquencies are anywhere from, so for unemployment rates, it's related to unemployment rate, really. Mm-hmm. So there's, projections, and of course this varies by state and market, anywhere from, 12 to 20% for second quarter 2020. And then, going out to, I'm just looking for, to, 6 to 10%, about 18 months out. So given that, serious delinquency rates could be anywhere from 5 to 12%, depending on unemployment. Coming into, just pre-COVID and safer at home, serious delinquency rates were down to 1.2%, which is, extremely low. So yeah, a significant increase is expected. Jeremy, what were your thoughts?
I would just simply add, if you're watching the forbearance numbers, I think, and they're in the millions now at this point, it sounds like a great deal whenever you're, getting to miss a payment, but it's not a grant. You do have to make that up. And to the extent that the cash flow is going to be strapped for borrowers to come out on the other side of forbearance and make up for that cash flow, I think that's going to put an added stress. And so the delinquencies are going to go up, forbearances are going to go up, which simply means that foreclosures are going to go up. Now, will it be as bad as 2007 and 8? It's hard to know at this point. Very different drivers behind what happened. If we snap back on jobs, then we have a fighting chance to not have a big, huge glut of foreclosures, but they're definitely going to be higher than what we've seen in the last couple of years. But that's probably not even a fair benchmark, because they've been as low as they've ever been in the last couple of years as well. Mm-hmm. So it may seem like that their year-over-year rates are really high. Well, remember what you're comparing to sometimes.
You make such a good point, because the media can often, they love their headlines. So if we're coming from almost no foreclosures or delinquencies to what might seem like a massive jump, it still might be low historically, but then people panic, and so people do need to be careful of the headlines that they see, for sure. Let's see. Again, I know we talked about it earlier, and you mentioned Houston, but are there any markets that you think might really boom in spite of everything going on because there is job growth? Is that even a thing?
Yeah, I don't know. It's funny. I mean, I've only been thinking about and focused on those that are going to be more negatively impacted, right? And as Jeremy said, I mean, just the obvious things around unemployment. I know that, negative equity today, right? States, it varies across state as far as negative equity share. So states like Texas have very low negative equity share, but states like Louisiana and Florida have much higher. So given that they do rely more on tourism and they already have, negative equity, higher negative equity or more issues there, those markets are probably, it's going to be much harder to come back than those that, were already stronger financially. Jeremy?
Sure.
Yeah, I would
Anything
just,
to add?
I think there is a triangulation that can be done with macro data based on some of the things we talked about before. So you can look at negative equity, and that's pretty obvious. We've got a lot of data. There's a lot of public data on where the negative equity sits. And then back to where we were talking about when it came to where job concentrations are. So if you take the reverse of it and you say, all right, where do we have strongly diversified markets? Dallas Fort Worth, where I live, is one of those markets.
Mm-hmm.
People that aren't in Texas, they may think, oh, everything in Texas is related to oil. That's not the case at all in Dallas Fort Worth. And so Dallas Fort Worth is an example of a market that has a lot of diversity in its job base. And it doesn't certainly have over reliance on tourism or hospitality. And so it's already in a state that has pretty good job growth numbers coming into this, and it doesn't have any kind of equity issues relative to its peer group. So I don't think it's that hard to try to triangulate based on some of those data factors to say, all right, this particular market, using Dallas Fort Worth as an example, should outperform. And if that's what you're trying to zero in on, outperformance markets, if you're an investor, maybe that's an approach that you could take to at least try to eliminate areas that might not make any sense at all. If you're also, another point on this, if you're a buy and hold renter, so as opposed to sort of a flip kind of person, you need to be paying a lot of attention to the regulations in that particular state or jurisdiction. There are, with the eviction moratoriums that are rampant at this point, there is going to be, in the more progressive areas of our country, I am fully expecting that moratorium evictions that started out 120 days will get extended. And so if I'm a buy and hold mom and pop or even institutional that's relying on rent, and I can't evict someone and they decide to not pay for whatever reason, then I've got a problem. So don't forget about the regulatory environment as it pertains to the eviction, whatever eviction changes are happening.
Oh, that's really good. So can you explain how you get your data and what you're tracking? Because everybody knows who you are. They might just not know how you get the data.
Sure, I can start on that. We service as CoreLogic multiple markets, right, across the whole property ecosystem. So from real estate through, mortgage originations and servicing, insurance. And so as part of that, we have several consortium type databases, right, that clients contribute to and we can analyze. And we also collect public record data through, tax and deed offices. So with that, we can pull together lots of different statistics and views with all different, slices of that, right, across industry, across location, so on and so forth, and bring that together for different insights. Rental property being one of them as well. So.
Yeah, I would add that there's a bunch of different ways. So we have 1,500 people that work at CoreLogic in what we call our enterprise data group, and that's what their job is. Their job is to procure data for us. And so this is what they do all day long. This is what they think. They are data nerds in every sense of the word, because
it's impressive. That's a lot of people.
It's a lot of people, and there's a lot of technology behind it. And we have ways that we can buy data. We have ways that we ingest it by the software that we provide. So we're one of the largest providers of software to the realtors themselves. So the MLS system, the main MLS system that most realtors use, it's a CoreLogic product. And so all the data that comes into MLS, we have that data. On the screening side, what I do a lot with multifamily, we have one of the largest, if not the largest, criminal databases. So I know whether or not Kathy, has a speeding ticket. That's in the database somewhere. So good. Glad that you don't. So there's a bunch of different ways. Sometimes we talk about what we call data exhaust. And that's what people don't really realize, is that when people are using software and they're ingesting data into it, whether it's an application or it's any kind of that data then resides, and there's a tremendous amount of insights that a company like CoreLogic, a big data company like CoreLogic, can then take with data scientists to be able to turn what seems like just random data across all kinds of different platforms, tie it all together, and now you have some very, very interesting insights about property, about people, or some combination therein.
Very good. All right. I really appreciate you being here and sharing your wisdom here on the Real Wealth Show. People are so scared, rightly so, and just being able to get really some, what I see it as extremely positive news, that with all the data that you're collecting, that you could still say that overall, through the end of the year, you think prices will still rise, although slightly. And again, that's I'm assuming the median price, but very, very great news. Thank you so much.
Thank you.
Thank you.
And thank you for joining me here on The Real Wealth Show. You can listen to this and any past episodes at realwealthshow.com. And when you're there, you'll get access to lots of data on which housing markets might be least affected by the coronavirus and which ones are expected to recover the most quickly. Again, you can get that information at realwealthshow.com.